So in this section, we're going to try and talk about financial modeling and what are the best practices in terms of financial modeling. What are the do's and don'ts? What are some of the common errors that I have seen a lot of people kind of commit while building financial models? And how do you kind of go about avoiding them, right? And there are a bunch of ways to kind of look at this. A lot of the errors are in the building of the model part, and a lot of the errors are sometimes that are seen in the conceptual part of it, right? So it's important to kind of understand what is the purpose of a valuation model, why are you building it, and what's the role of the valuation model eventually, or financial model eventually, in terms of the output that you're trying to generate out of it, right? So that's the construct, what we are basically looking at, or what we are trying to kind of focus on in this segment. So first, questions first, in terms of, if you look at a financial model, what is the purpose of a financial model, right? And that itself sort of starts kind of giving you an idea about how do you look at a financial model, or how do you look at building a financial model, right? So a financial model, read the definition that is there. Financial model is a means to help you analyze and evaluate a business. I'll repeat, financial model is a means to help you analyze and evaluate a business. There are a few keywords here. First one being it's a means. Second one being is to help you. And third is analyze and evaluate a business, right? So there are sort of three segments here that we are trying to kind of look at. The first one, so let's actually start backwards in terms of, the idea. You are trying to evaluate a business. That's your primary end objective. That's your end goal, that you are evaluating a business. And your objective is to try and basically work with that in the contour of building a model. The primary objective is, at the end of the entire exercise, you should be able to kind of have, with a certain confidence, some semblance of understanding of the business. That's your objective, right? The model is a means to achieve that objective. So the idea of the model is that when you're building the model, you will understand more about the business, you will learn more about the business. And as you learn more about the business, you will be able to kind of decode the business slightly better and understand the business slightly better, right? And the third part is the model is helping you. This is important because a lot of the times what tends to happen is, when we are building a financial model in Excel, a very common issue that we tend to see is that we think Excel is the end goal, and I am helping Excel arrive at a number. It's actually the other way around. The end goal is the objective to analyze a business, and Excel is helping me arrive at that particular result, right? So Excel is the tool that is helping me build and understand the business, right? Or build an understanding for the business, correct? It is key to evaluate this, to understand this, because this is the core construct. The moment you start looking at this from this perspective, you will realize what you need as an output out of it, right? The model itself has to be a reflection of the business of the company. It should tell us what is unique about the business. The flow should incorporate key sectoral assumptions such as industry growth, market share, pricing dynamics, etc. I'll tell you where I'm coming from when we talk about it. But the key element here is that the model is trying to showcase how a business works. So when you open a model, you should get a sense of what drives the business, what are the risks in the business, and how do you sort of evaluate those specific risks, or how do you model that particular business in an Excel file, right? The corollary to this is that if you have built two different financial models of two different companies in two different sectors, and they look exactly the same, right? Then that model is not really serving its purpose completely, right? I mean, it is obviously serving some purpose, but it is not going to help you evaluate a business with a lot of confidence unless you have actually modeled the flow of the business somehow. So, how does the company make money? Where does the company spend money? Is it a capital intensive business? Is it a working capital heavy business? Unless a lot of that flows into your modeling exercise, it will be difficult to derive the output as you desire out of it, right? So that's the key element, that it should have key elements or key assumptions about the sector, because once you understand the sector, then your data flows in there. And I'll give you an example of where that is relevant and how that is relevant, right? Let's look at some of the sort of issues. So best practices, conceptual errors to avoid, right? And there are a few conceptual errors. So the first one is historical growth rate is used a lot of the time. So I'll break it down into two parts. One is the conceptual errors. The second is the Excel errors, essentially, that, how do you kind of structure and position it and put it out. So first, conceptual errors in terms of financial modeling. So the first one is historical growth is typically used to kind of project future revenues. Very common and not incorrect completely, because a lot of the times history does suggest what's going to happen in the future. And in the absence of any other information, that's a fair bit to kind of use. The challenge, however, is that this inherently says that a company that is growing will keep growing and a company that is not growing will never grow. And so companies that are changing their business profile or industries which are changing their growth rates, it is very difficult to model them here, right? And you tend to miss most of those elements. Forecasting is, it's taught that way, that you look at a linear regression or a linear sort of forecast and try and basically based on that. And then, as the company keeps becoming larger, you kind of keep making the growth rate smaller. But in real life, it doesn't work that way. I mean, if you were modeling a trend, right? For example, in 2021 or 2022, could you have modeled Zudio the way you would have looked at? I mean, there are at least 6-7 companies that have gone up like 10 times in the last 5 years in the stock market capitalization basis. And their earnings growth have been, their sales growth itself has been north of 30-35% per annum over the last 5-6 years. How would you model something like this? Right? I can give you examples after examples. I mean, in 2010, Eicher Motors used to sell 50,000 Royal Enfield bikes a year. In 2018, they were selling 70,000 a month. 50,000 a year to 70,000 a month, right? In a span of about 7 to 8 years. How would you model this if you're looking at historical growth rates and you're not really building in the point that there is an inflection point that a business might find in terms of, right? If you look at the period between 2014 and 2018, Maruti was doing remarkably well, right? Maruti's revenues were growing significantly, right? But post 2018 till 2024, 2023 actually, growth rate just kind of got stuck, right? So that's important to kind of understand and look at in that purview as to how you are looking at this thing. So that's the first problem, that, if you just use historical numbers to try and basically project what's going to happen in the future, that tends to sort of lose the essence of how the business can develop. Sometimes companies can grow fast, sometimes they face headwinds, or, you have to understand where that is coming from and how that is coming from. Without actually projecting or understanding the business, it tends to become difficult, right? So I'm not a very big fan of using historical growth rates in general, but yeah, in the absence of anything, you can use it to identify trends. I mean, the percentage numbers are okay. So DMart's gross margin over the past many years has been about 15%, right? 14 to 15%. So that could be used as an input to say, okay, they seem to be passing on any kind of price rise to maintain that 14% or 15% number. But DMart's growth rate was 15% or 20%, and I assume that that's going to continue in the future. That may be incorrect. I will have to kind of try and at least put my head towards it in terms of figuring out how do I go and model that particular data. Right now, of course, it's not easy, and you're not necessarily going to get the answer straight away. But without breaking your head over it, it's not going to go too far. That's problem number one that you should be avoiding. Problem two is when you're modeling and you're doing a DCF exercise, typically what tends to happen is DCF has a sort of a projection period where you're explicitly projecting it. And then everything after that goes into the terminal value. Right now, I won't get into the calculations at this point, but broadly, the terminal value will basically depend on last year's cash flow into a certain growth rate divided by cost of capital minus that growth rate. That's the formula. So if you do not forecast for a fair enough period, right, then the terminal value becomes a very large component of your overall value, right? And what that does, that terminal value is basically depending on one number, which is this growth rate. So if you increase the growth rate, your terminal value will be higher. If you decrease the growth rate, your terminal value is lower. Again, that tends to kind of distort. As a thumb rule, if more than 60%, 50 to 60% of your value is coming from the terminal value, then you have forecasted for a smaller period. You need to forecast more, right? And there's no sort of going around this. You have to kind of put your head and try and kind of focus a little bit more and add more numbers, add more years before. So what's typically happening in this case is a company is growing at 20, 20, 30, 30% kind of a rate. And then suddenly you are assuming a 6% growth rate after that. Right. So that's very sort of unrealistic, unnatural kind of an assumption. So you have to figure out a high growth period, a tapering down period, and then you assume a steady state. If you're modeling something like a DMart or you're modeling something like a Zomato, you can't be assuming a forecast period till 2028 or 2029 and then just assume a certain period after that. It's very difficult to sort of get a correct sense of value, and you'll get some value, but it'll be highly dependent on what growth you're assuming after that. Right. So that just makes it more susceptible, more sensitive to the data. Inconsistent assumptions. Now, if you are projecting sales and sales is growing, but some other thing is broken somewhere and they're not sort of talking to each other, the financial statements are not talking to each other, then I've seen models where sales are growing at 12% and profits are growing at 30%, and over a slightly longer period, you'll find that because these are two things that are projected separately, uh, sometimes you kind of get very sort of inconsistent values, like your EBITDA is bigger than the sales, correct? Because they've both been projected separately. And that obviously doesn't make sense because, it doesn't. So you have to figure out how to solve for these inconsistencies. A lot of these inconsistencies get resolved directly if you project the balance sheet. Right. So conceptual errors that you're avoiding is, if there's no balance sheet projection, then you have not really modeled it completely. There has to be a projection of all the financial statements, P&L, cash flow, and balance sheet, and they need to be talking to each other. If they're talking to each other, then you can try and find out a ratio. For example, you have assumed sales growth, but you have not assumed capex, right? So what is going to happen is your fixed asset turnover ratio, right, which is sales upon fixed assets, will start sort of going all over the place, right? It'll start suddenly increasing as against what historical trends are. So that's just a simple inconsistency that you can capture, but you'll only capture that if you've linked everything together. If you're projecting data points separately, then it won't work, right? So it's important that there are balance sheet projections. At all points of time, the balance sheet has to balance, right? And when you move data somewhere, the model has to remain consistent. It's not like I change an assumption and the balance sheet goes for a toss. That can't happen. So important to kind of put that in. Most of the times, if you project the three financial statements and they are talking to each other, point 3, which is inconsistent assumptions, will get taken care of because you will sort of catch any inconsistencies, right? Very common error I find, again, because there are disjoint sort of calculations that happen, is cost of debt comes out as greater than cost of equity. Now, simple corporate finance concept that if you are putting money as a debt holder in the company, your priority of payment will be before the equity holder, always. So the equity holder is always going to have a higher risk than the debt holder. Because the equity holder is always going to have a higher risk than the debt holder, at any given point of time, the equity holder is going to expect a bigger return. And hence cost of equity has to be higher than cost of debt. The challenge occurs because sometimes what happens is we just calculate cost of debt as, we'll take interest cost and we'll divide it by the borrowing number. Now, there can be many reasons this might be different. For example, let's say interest cost is 20, borrowing is 100, you'll get a number of 20% for a good company, right? For a large, good company with very limited amount of debt, you get interest cost as 20%, cost of debt as 20%. This is inconsistent. There could be multiple reasons for it, right? One of the simplest reasons could be that this borrowing data is as of March 2024. Maybe the company had more loans during the year and hence the interest is calculated over the average loan through the year. And just in the month of March, the company doesn't have loans. Even if you take year-end averages, which is last year and this year average, you might still find that as a problem, right? When you get this, you have to basically figure out whether the cost of debt or cost of equity makes sense. The other way around is also possible. You calculated beta statistically, beta comes to 0.05. And so your cost of equity becomes like something like close to, 7%, right? That also wouldn't make sense. I mean, intuitively, would you accept 7% return from a stock? If the answer is yes, then that's fine. If the answer is no, then, you have to kind of rework. When you're modeling, there could be statistical issues in terms of how data is being picked up. right? This is an example where cost of debt could be too high. There could be examples where beta is incorrectly calculated. And I'm not saying incorrectly calculated as a process, incorrect in terms of, it's a statistical data on, if you pick a certain period of time, it is quite possible that if the stock is illiquid, you might get spurious values there. You have to kind of, so just to give you an example, if let's say I'm modeling a real estate company and I calculate the beta for that and I end up getting a beta of 0.5, I need to check this a little bit, right? Because generally real estate companies are more volatile, they are capital heavy. There's a lot of uh, capital intensive in business. It's a cyclical business. There's a lot of capital involved when the business is going on. So it's inherently risky as a business, right? And works in very long-term cycles. So if I'm getting the beta as 0.5, there better be a reason on why the market is ascribing such a low beta to it. And if I'm not able to kind of find that, I mean, maybe the business model is changing, maybe they are deleveraging or whatever. But if I'm not able to find that reason, then I need to be careful with this data. I probably need to look at other data points, other periods when I'm looking at it, or other companies and try and find a fundamental beta and look at that. But intuitively, cost of debt cannot be more than cost of equity. It has to be less than, right? So that's the data, right? So that's something that is kind of going to come in. And then finally, no scenario analysis. Remember, go back to the first point. You are building a model to help analyze a business or evaluate a business, right? There are 20, 25 inputs that are going into that model, right? And while you would want to keep it generically simple and all, sometimes you have to kind of make certain assumptions, and there is a little bit of subjectivity involved in those assumptions, right? It is important to understand that you change a few variables here or there, the value could change. So there are two reasons why scenario analysis is important. Reason number one is, of course, there are 20 inputs, so you're not sure whether all those 20 are correct or not in the first place, right? And in fact, contrary to the industry opinion, I always sort of suggest that when you come up with an equity valuation report, you should give a range of values, right? Because when you say a single target value, you're saying all my 20 assumptions are my base case. Which is a bit too much if you've kind of started right from industry assumptions and so on and so forth. So you change the variables a little bit and try and find the range of values and see, okay, this looks to be the most relevant range of value. The other point is sensitivity analysis tells you, or scenario analysis tells you what variables, you have to be careful about, right? So for example, if you are modeling something that is a metal company, although metal companies don't work very well on DCF, but I typically do that as an example just to show the challenges there. If you were to model a steel company, 5% increase in steel price and a 5% decrease in steel price can change the stock value from minus 70% to plus 70% from where it is, right? And I'm not exaggerating. It could actually be more in that sense. So when you do scenario or sensitivity analysis, it starts telling you that, okay, there are certain variables you have to be very careful about. And there are certain variables where you just don't have a sense. And, you just have to kind of track them on a more frequent basis. If you're modeling something like Infosys, you will realize it's highly dependent on the currency value. Now, currency value is very difficult to project, right? I mean, if you ask anybody what's the value going to be 2026, 2027, difficult to kind of come up with a very sensible judgment around it. I mean, generically, people assume it's going to kind of depreciate because that's been the history. But there's no real reason to sort of go and pinpoint and say it has to be 86 or it has to be 89 or it has to be 92 or it has to be 83 or whatever. So things can go wrong there. So you have to be a bit careful and keep sort of reassessing that. And scenario or sensitivity analysis sort of helps you arrive at some of those judgments when you're looking at this, right? So that's something that is, again, a very relevant and important point in terms of conceptual errors to avoid. So that's the bunch of conceptual errors that I've come across. How do you kind of go about avoiding it? Of course, some of this comes with time as you kind of keep analyzing a company, keep reading about a company. You kind of get to that point and, you sort of are able to model it. Then comes around some modeling best practices, right? So I'm going to kind of put a few here. And I'm going to show you a model as well as to how to kind of structure it. So put all the assumptions as far as possible in a separate sheet. Create a separate sheet and put almost all your assumptions in that separate sheet, where you can basically think this is the brain of your model. So everything is flowing from there. That's the one sheet you kind of go again and check and change and do whatever you have to do with. And that is where the entire logic also is built in. I mean, you could kind of work around a few more things. I for example, prefer that I keep all my assumptions about elements around P&L and working capital on the assumption sheet. CapEx has a separate schedule, debt has a separate schedule, right? So if you want to look about it, you're looking at basically three elements. If you look at cash flow from operating activities, cash flow from operating activities in a business relies on data from the P&L and relies on data around working capital. So all of this is on one sheet. Then you look at cash flow from investing activities. This is all your CapEx. So that's coming from your CapEx schedule, right? And cash flow from financing activities, that's going to be typically from your debt schedule, right? If a company is raising equity, then you could have an equity schedule as well, right? So that's the construct of how do you look at, make separate sheets for it. This is not a definitive thing you have to do. It's okay if you want to model everything on one single sheet, that's also fine. But if you model it separately, it's just easier to kind of navigate in that sense that, you know, you have one particular logic that is flowing in a particular sheet and that's dedicated to that, right? Of course, you can add more sheets as well as you go along, right? So balance sheet, P&L, cash flows, CapEx, debt schedule, WACC calculation, and your DCF, and then relative valuation, whatever you want to do, you kind of put all of that in, right? Mention source of information and assumptions. Now, when you're building a financial model, especially, you know, also from the purview of building a career in this area, right? Two reasons. One, teams work on models. Somebody else is going to look at your model. So if you can mention where have you gotten a particular assumption or data from, it's generally helpful for the next person reading it, right? Second, as you keep sort of growing in the career and industry, you would have worked on like 20 different companies. You would have made 20 different models over a period of time. And you know, there'll be sometimes cases where you wouldn't have revisited a model for a year. Now you go back and look that model. We ourselves tend to forget a lot of the times, why did I make a certain assumptions or assumption, or where did it come from, right? It's always a good practice to kind of mention the sources, generally a good practice, right? Explicit projection should be created for at least 4 to 5 years, preferably 7 to 10 years, sometimes even more than that. You should be projecting all financial statements, P&L, balance sheet, cash flows, of course, because you're going to kind of discount that anyways. The balance sheet should be balanced and dynamic. What do I mean by dynamic? Basically, you change some assumption somewhere, it should automatically change the balance sheet, P&L, cash flows, everything. And everything should kind of be in sync together. Balance sheet should remain balanced, whether you change any assumption anywhere. Once the model is done, the only thing you change is the assumptions, right? That's basically where it is. Without a balance sheet projection, it typically is incomplete because a lot of things might be inconsistent in it. You know, sometimes we just project sales without knowing whether the company has the balance sheet strength to kind of go and you know, build that scale. So that's where I think it is very, very important to kind of focus on the balance sheet. Lot of time is spent on P&Ls in general, which is fine because that's eventually the report card of the business. But if you are projecting the balance sheet, then some of the survival questions about the business kind of come to the fore that, you know, so just to give you an example, we, in one of our programs, we build a model on Steel Authority of India, and, you know, Steel Authority of India, if you go and read through their con call transcripts, they've come out and said, we're going to do a capex of 1 lakh crore, right, over the next 7-8 years. Abhi, how will you do 1 lakh crore? I mean, assuming a debt equity of 1:1, you will have to basically go and borrow 50,000 crore of debt. Does the balance sheet actually support that 50,000 crore of borrowing, right? Maybe it does, maybe it doesn't. But unless you project the balance sheet, you will not be able to kind of figure out, you know, what happens after they have raised 50,000 crore of debt, half of the total capex that is there. And does that create a risk at some point of time? So that projection overall has to kind of happen in terms of your overall understanding of the data, right? Next up, you get on to data points like hard coding. So when you're punching in data, right, a lot of the times we just hard code data, especially for projections as well, right? Where projections are typically coming from a linkage or a formula. Do not hard code data except historical data. Unless there's a clear reason around it, right? Assumptions are okay because you might be saying, okay, I'm going to assume 4% growth on something, and I've kind of hard coded the 4% growth number. But you know, so 100 into 1 plus 4% is 104. Don't hard code 104. right? 104 is a calculation that should come, right? Use secondary checks. So, various ways to do secondary checks. I mean, one example I showed about fixed asset turnover ratio is that when you're projecting sales, have you projected capex, right? Is your margin going up significantly, right? Is your margin going down significantly? Is the debt equity ratio changing dramatically, right? Is the company's capex just too high or too low in the context of your calculations? Are you making inconsistent assumptions about working capital? So some of these ratios, you will see if the ratio is just going too far high or too far low, you get a sense of, something is missing there, right? Or you have to kind of think a little bit more about it. So that's something that is relevant. Avoid circular references. Now, what are circular references? You say that depreciation is a percentage of, assets, and assets are kind of looking at what is the depreciation because that is the maintenance capex, right? So you're saying gross fixed assets is, let's say, 100,000 and depreciation is, let's say, 5,000. You're saying 5,000 is depreciation, so I have to do maintenance capex this year. So that will add to the gross fixed assets. Or you're calculating other income as a percentage of cash, right? And then other income is calculated as a percentage of cash, and then that cash goes into the cash and bank balances, which gives you the final value, which gives you the other income, and other income gives you the net profit that changes, and so it goes into a circularity. Understood? Other income will go and get added to the net profit. Net profit will go into the cash flow, will give you the final cash value. And this cash value will then change the other income, and then it'll keep moving at that. So avoid as far as possible. If you can't, sometimes you can't. In certain specific kind of segments, you can't. For example, there are infrastructure project modeling if you're doing. Then there are metrics around debt service coverage ratio, right? Where you are trying to create a reserve account and you calculate the cash flow and you say, if the cash flow is there, then I will repay the debt, right? So there is a circularity that will get built into that because that's how a lot of, especially if you're kind of looking at a private equity fund that is going and putting money in a real estate asset or infrastructure asset like a toll road, right? So they have a specific concession period of 20 years or 25 years. In that period, they have to operate that toll road. They might get cash flows. If they get cash flows, they have to kind of repay the debt. So there is a circularity involved there. Sometimes you can't avoid it. If you can't avoid it, then you tell how you're dealing with it. There are breakers that are applied there. Again, beyond the scope of this, but as far as possible for basic modeling, avoid circular references as far as possible. And very critical, especially if you're sending your model for review to somebody, use consistent formatting, right? Decimal should be consistent. Do not put, one number saying, 1020, another number saying 1031.8, the third number saying 831.327. It's very difficult visually to kind of look at these three numbers. Which one is the largest number out of these three? Yeah, and big put off if you're sending this model to somebody to evaluate, especially from a career perspective. So be very clear about what decimal points you're going to use, what is the forecasted data, what is the historical data, what are linkages, what are calculations. Everything needs to be kind of consistently defined in that context, right? If you haven't defined it consistently, it sort of tends to take away, the essence of that model in that context. So it's important to kind of look at that data and evaluate it from that purview, right? So that's something that you want to kind of look at as well. When you are modeling something, right, the key that you want to kind of look at, the key that you want to be focusing on in terms of building a model is ensure that your model tries to answer these questions, right? How does the business make money? How big is the opportunity to grow, right? Now, unless you know how big is the opportunity to grow, how will you assume a sales growth number, right? I mean, it's important to kind of have a sense of how big the company can become potentially, right? And, how big it can't become potentially, right? If I just keep assuming a certain amount of growth rate on passenger car sales, it's not going to work because, passenger car sales are stagnant or two-wheeler sales are stagnant in India, right? For the last 7-8 years almost. Uh, I think 2023 sales were the same number as 2017 sales in two-wheelers in India, right? So you have to have a sense of where is saturation coming in a particular segment. So how big is the opportunity to grow? The assumption, if you're saying sales growth is at 10%, how does that come? Can it be higher or lower? Why? So that's an important aspect. Why should I assume a certain margin? Is the cost structure completely in control? So see, a lot of the times what we do is we assume costs as percentage of sales, correct? So when you're modeling cost as a percentage of sales, if I just take, let's say, raw material cost as a percentage of sales, I have inherently made two assumptions here. One, raw material cost moves in tandem with sales, which is not necessarily true in a lot of businesses. I mean, limestone prices and cement prices may not necessarily move in tandem. Iron ore prices or coal prices and steel prices may not move in tandem, right? So there is a potential possibility that raw material and end product prices don't move in tandem. The second is you have inherently assumed if this number is constant that whenever it changes, the raw material price changes, the company is able to pass that on, right, to the end user. That may also not be possible. If coal prices go up or iron ore prices go up, a steel company may not be able to pass on the cost, right? Because steel prices are defined globally. So inherently you have to assume where is the margin coming from and is the cost structure completely in control of the firm? These are some questions that you'll have to dig deeper to understand the business, right? Can Jio keep increasing prices of telecom subscriptions? Can Airtel keep increasing prices, right? What is the likely scenario at some point of time that is going to play out, right? Uh, why doesn't Relaxo increase prices dramatically for its footwear, right? So you'll get a sense when you start kind of asking those questions. How would the business maintain margins? If you're saying it will maintain margins, how would it maintain margins? Is the cost of capital calculated making sense? Now you calculated using all high funda calculations like CAPM model and everything. See, at the end of the day, CAPM is again a tool to come up with a sensible number, right? And on a spectrum of companies, you'll get a sense that, okay, if Nifty, you're expecting, let's say, argument's sake, a 13% return, which is your cost of capital for, let's say, Nifty, then where on this scale HUL will come and where on this scale Infosys will come and where on the scale DLF will come and Tata Steel will come. You'll know that for Tata Steel, you would expect a higher number. How much higher is a debatable question. We can discuss that as we go along. And you'll know that for HUL, you'll probably expect a lower number than 13%. Now, when you're calculating your WACC and you suddenly get the cost of capital as the opposite number, then you have to use some sense and subjectivity and uh, your mind or application in terms of understanding that, look, this doesn't make sense. Maybe the data is sort of confusing me. So I need to be looking at, do I need to look at ancillary data sources around it, right? How would CapEx impact this business? How would the business kind of go about sort of looking at various segments and phenomena and, can the company do CapEx? The company has announced I'll do CapEx. Will they be able to do it? Will they be able to fund it through internal accruals or will they have to borrow? If they borrow, what does that do? If this company does capex and the competitor does capex, what does that do to capacity and supply and prices of the industry? So a bunch of things kind of have to come up that you try to answer. Go back to the first question. You are trying to analyze and evaluate a business. So everything that goes into that business, decision making, is a key element that you want to kind of look at when you're trying to model it. If your model does it, it's great. If your model doesn't do it, then you need to try and at least have the basic points covered in that particular sense. So let me try and see if I can show you one of these models. So this is something that's there on Infosys, and we typically use this in one of our core programs. And typically you'll see that there are a bunch of sheets here, starting from the balance sheet and the P&L and the data and assumption sheet. So data and assumption is the brain of the model. And you'll see very clearly that there's a historical construct and there's a forecast period. The forecast in terms of the headers is highlighted in terms of blue headers, navy blue, and the historical period is green. And then as you go further, I don't know if it is kind of clearly visible here, but there are certain data points that are kind of clearly highlighted as the assumption data points. So the shaded cells are all assumptions that kind of go through. Typically, most of the places that you will see sort of consistency in terms of the decimal points and the way data has been represented, along with what are the units that are mentioned on the left side column typically, right? So that's the flow that will essentially kind of ensure that this data is happening. You'll also see some specific color coding here. For example, you will see that numbers that are hard coded are typically sort of in the black color, and then you have this slightly different color where these are linkages. So it's a link to the previous year number. That's what's been assumed here, right? So basically, color coding itself is going to kind of give you a certain sense of data. If you go to the PNL, you'll see all of these are data points which are being derived or linked to the assumption sheet, and the black numbers are all calculations that are there, right? So the greenish, dark greenish font on the forecast is basically where you are saying it's a link to another cell in the model, and calculations are all kind of in the black format that are there. So just makes it easier to read and understand when you immediately look at it. If that sort of legend is clearly created, that there is a specific color we have used for linkages, and there's a specific color we've used for hard-coded numbers, and there's a specific shading we've used for where the assumptions are happening. It just makes life easier for somebody who's going through something like this, right? I'm not saying this is the only way you have to do it. There are various ways of doing it. You can define your own method, and I have seen models which are far, far better than what you're seeing on the screen, right? And every few months now or then I come across something that's just like blows my mind away in terms of how well the model has been structured and made, how well how well and easy it is to read that particular model. The model is telling you a story, right? That story should kind of appear very clearly as to what is flowing through that business in that. And if you can do that, then that's a superpower that kind of comes along with that. So that would be what my broad inputs would be in terms of the details around a lot of these valuation modeling best practices that would come in. Of course, there's more. I mean, you can keep improving on it. I keep doing that even today in terms of looking at something and saying, okay, let's change this, let's change that, and see how the model improves and how the model goes. Not just on the conceptual framework, also on the look and feel framework, that you can try out things and say, okay, what if I sort of use a different color coding or a different font or a different sort of structure, and see how that looks. But just keep it consistent, keep it readable, keep it simple to understand, right? And the complexity is more in your thought process, that you understand the business more in a more detailed manner. The model should allow you to kind of frame those questions in your mind that help you decode the business. You may not get all the answers on day one. That's a natural progression. Over a period of time, you will arrive at answers as you go along. But the model should allow you to kind of at least frame or define those questions as you're going along and look at those in detail, right? So that's the construct in terms of our discussion. That, in a nutshell, is what I wanted to kind of cover in our section today. Yep, so that's broadly it from my end. Thanks a lot on this.